This is a podcast produced for EIS Platforms Limited, trading as Growth Invest. It is not intended to be a financial promotion of any sort and is intended for financial professionals only. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high-risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you're prepared to lose all your money.
Hello, and welcome to the Alternative Thinking Podcast with Steve Dobson and Melissa Griffiths. This is the podcast that takes a deeper dive into the alternative marketplace and explores topical issues. We're delighted to have back in today our regular guest, Paul Mattick from Mercia and the Northern VCTs, and Nick Priest from Downing.
Hello.
Hello. Now, obviously, we're all in black tie attire because we're off to the Growth Investor Awards tonight.
Yep.
Which celebrates tax-efficient investments in the marketplace. So I think, Steve, you were going to do a cheers?
Oh, yes. We'll raise a toast to the future winners of the awards this evening.
Cheers, Nick.
Cheers. Cheers.
Cheers.
Cheers.
And Paul has pulled me up on a few occasions for being, not the most well-dressed. So I'm a little bit disappointed that he's outshone me again by going with a full velvet.
Oh, I don't know. You look pretty smart.
Well, you look like a red velvet cake. I mean, it's phenomenal.
It's quite embarrassing being between you two, actually.
The bromance going on.
Yeah.
Right, well, moving swiftly on. I think to start with, we were going to just really look at the tax-efficient season to date. We're sort of really a couple of months in. So who wants to start off?
I'm happy to pick up, and it feels like, well, we're over halfway through the year, but you're right. It feels like it's just started, really. It kicks off in September. And looking at EIS first, which is a market I know well, and we've got the Mercia EIS, and which, I think this year it's a bit subdued so far.
Yeah.
I think there is, I'm sure we'll talk about this later on, but the budget is not too long.
Which is late as well, isn't it?
It is late, and I think people are waiting for that to see what happens. Across the market, it feels subdued so far. There has been some decent exit activity, some decent amount of cash going back to investors from EIS products realising some of their portfolio companies, but that hasn't actually resulted in big inflows so far.
Okay.
Which is interesting, and that probably talks to the sentiment of the market at the moment. Everyone's being a bit more cautious, I would say.
Yes.
And there's lots of chat about bubbles and things, but let's not go there.
No.
So I think people are being a bit more cautious on the EIS taking risk at this stage. We'll see. I think there's other wins, and we'll talk about tailwinds with pension reform coming up later on. But I think I'm sure Nick will talk about that in a minute. But an EIS, so it is down. I think it's been down for a number of years across EIS funds, but also more broadly across EIS market, which includes single companies, etc., etc. VCT market, which I'll cover as well, if that's okay.
Mm-hmm.
Yep.
It's early in the season.
That's looking better, isn't it?
Well, yeah, it's early in the season for VCT, so offers launch often September, but a lot come out in January. It's a different kind of dynamic within VCT, and there's kind of a lot of demand and less supply often. So you would almost always the large managers with their VCT offers will get filled, and then some of the smaller managers maybe not get fully filled. And it can be a struggle with the new managers because they've got the dividends flowing and such. But we do have, it's been okay so far. We've got an offer in the market, it's doing pretty well. But there are less big offers out in the VCT market at the moment. And there are some more coming into the market. But I think it will be constrained supply this year.
Right.
So what that means for demand, we'll see. I think we can talk about the offers which are open, but we can't see any £100 million plus. Well, there's one. There's not many really big offers that are coming to the market.
Mm-hmm. Yep.
So I think that's but I think we are, VCT is down so far, but I think it will again probably get to similar size as it was last year. Maybe a little bit down, just the lack of product supply. But I think, it feels much more buoyant than EIS market, certainly.
How far down do you think it will be? Because I was looking at the tracking numbers year to date relative to last year. Last year we were probably around about just north of 200 million at this stage, and I think we're probably around about 130 at the moment. With, as you say, a couple of the big names have already gone out with their raises. There's only a couple of bigger manager raises, I would say, to come early in the next year. So where do you think we finished relative to last year?
At this stage, it's really hard to say. And as I was saying, I think the smaller managers and the smaller VCTs may get enhanced flows. So if previously they hadn't got filled their full allotment, then their full offer, then perhaps this year, if there's still demand out there, they will get they fill their offers. But none of those will be really big offers. No. So I think it will be down because there's not as much product available. Correct, quite simply. Even if there's demand, there's not enough product to satisfy the demand. But I think part of the absence of some of the larger managers, they're not coming with their offer this year, means that their relationships with normally the lots of small IFAs and advisors, wealth managers, they may not be may not be participating in the market this year. It may just be the large wealth managers we know who are allocating to VCT, but the smaller ones may take a step back this year. So I think there will be both supply and demand will be less. So you're going to put a number to it. I think it'd probably be more like 700, 650, 700 rather than 8,
was it
9.
880 last year? Yeah.
Which is similar to 21, I think, isn't it? I think that was around the 600.
Yeah, I think we've got used to the kind of the billion mark for the last few years, but you have to have enough product as well as demand, and there's not as much product out there at the moment. Yeah. But I suspect that the large managers over the next few years will be looking to deploy more. So the thing with VCTs, it's no point raising if we haven't deployed already. So we at Mercia, Northern VCT, we always think about deployment first, and then we raise the capital to match it, because there's always some cash in the VCTs. But until you deploy larger amounts, which we are this year, then you've got to have a question whether it's appropriate to raise more. We don't want to be sitting on lots of cash and finding somewhere for it to go. That's not good investment. That's not a good strategy.
And you've seen the opportunities out there then for that money to be invested?
Yes, there are definitely lots of series. There's always a big gap around Series A, Series B. And hopefully the more money we can get into this space means that can fund later stage businesses, and they can expand in the UK rather than being acquired by the US or having an inward investment from the US. But because we're seeing a lot of that as well. But
or even IPO.
As we did in last month.
Exactly, with the LED mask. Which I actually have one.
That explains it. The radiant glow.
Yes. The beauty tech group. A month ago we took that company onto London Stock Exchange, onto non-AIM.
And that was on the big market.
Yeah. So it's got decent revenues, about 300 million valuation around there now. So that's a great example. And getting something onto the stock market is challenging at the moment, but hopefully that will start to open up for other people as well. And I know various other managers are looking at portfolio companies coming onto the market.
That's interesting, yeah.
And there's been more. I mean, I know some of the brokers are doing more IPOs as well coming through, aren't they? It's picking up.
It certainly is. And obviously within broader technology and with there's lots of noise around AI, the valuations are going nuts. Things are moving really quickly. Businesses actually can be built more quickly now. So the productivity tools, even things like ChatGPT at a very basic level, can help you do your research. And so people should be being more productive in building companies more quickly. And I think there's a race to find the first £1 billion company with one person is something that's been talked about. And in some ways, that's not necessarily good for venture capital, because it means they don't need much capital to scale to that size. But I think it'd be great for the economy, though.
Yes. So, yeah.
Okay, let's move on to.
Well, before you do, I was just going to ask Paul about what the advisors are saying in terms of VCTs. What feedback are you getting from the advisor market? Because if you're saying that it feels like there's demand out there, but there's an undersupply in the marketplace. We've had recent years, where good offers have sold out really quickly, and it always seems to be quite a challenge for advisors. Are they worried about that? If there's less supply and the market could hoover it up really quickly?
To a certain extent, yes, but I don't think that's. A couple of years ago, offers were getting filled in days, like a week, 2 weeks, and that's not happening at the moment. But I don't know if kind of the sentiment turns around to say in EIS it feels quite slow, and VCT I don't think it's super buoyant, but it's steady.
Well, and Albion's early bird went quite quickly. That was one that's come out recently. I think from our sort of perspective, I think a lot of the advisors are waiting for the budget. I think that is just generally the feeling. I mean, that's why I was going to ask you about, what you're seeing, because obviously the IHT is very different.
But again, I think just before we jump on that, I think the dynamic of the market's changed somewhat in that most of the big managers and VCTs now delay the application opening. For like a week after the prospectus, so it allows the advised market to get their everything in line, such that they're not disadvantaged theoretically.
The problem is execution only can move so quickly, whereas wealth managers take a while to wind up both their processes and then get advice out. So typically, the first week or two is almost entirely execution only from our perspective, and then advisors slowly turn
even
on.
still with the lag in terms of
a week's no time at all, I think, to turn all that round.
It doesn't work like that,
and they often have to build them into annual reviews, and that's when they're doing those. So
week on week, we're seeing more and more advised business coming in.
Fine.
And
I think that there's just definitely a view that January, particularly, it could really pick up.
Well, I think some will be closed by then. I mean,
Paul,
I guess you're hoping that Northern will be closed by then.
Well, my bet before we opened was that it would be done by the 26th of November. Everyone else was in February, March. I'm a bit more aggressive, should we say. But we're 32 million out of 50 in a month. So I think it probably will be after the budget now. And how far after the budget? Then you roll into Christmas, and then January, first couple of weeks of January is dead. Yeah. So it may be end of January, maybe, but unless we see a big pickup in the run-up to the budget, which is also quite possible. We've got an allotment on the 9th, got an allotment on the 25th, which we were going to do it in kind of late November, early December, and I thought, well, if the budget's then, let's just do it the day before.
Have one before,
So, but I don't think, from my understanding, I don't think there's going to be anything in the budget to look at these venture capital schemes. But I wonder if they're going to tinker with IHT again. I hope not after last year.
I don't think so. I don't think so is what we're hearing.
Okay.
I think that a lot of that was done last year and got out the way. I think what we've all been waiting for during the course of this year, and we've discussed this on this podcast before, is really just trying to get some clarification on some of the nuances to those changes. But what we've seen in the BR market is inflows up. So the market itself is tracking to be up about 17% in the unquoted market year on year. So that's significant. We also a couple of weeks ago had the revenue come out and say where the IHT receipts were at the half year stage, and that was £100 million up. It's not huge numbers, but it's tracking in the same direction. And that's before a lot of these changes come in. So the BR changes around AIM and the cap on unquoted is coming in next year. The pension changes are coming in 2027. Yeah. So that's before any of these changes are really coming to play. We're already seeing IHT receipts up, which is not a massive surprise. I think the thing that we have seen as a trend and what I think leads to the BR market being up is really around pensions, where people are starting to look at that now and saying, well, we've been planning this in pensions using it as an IHT mitigating tool, and now that's not going to work. And client by client, if you're elderly and in ill health, then it doesn't make sense because you're in an IHT friendly vehicle until 2027. But if you're a bit younger and in good health, it does make sense if you have to qualify for business relief to pull it out now, not wait until you're older in 2027 and get the money into something else.
Yeah.
We were talking a minute ago about the FCA retirement income market data that tells us that that withdrawals from pensions year on year are up 36% to £70 billion, and that's really significant.
Yes.
And our conversations, I was asking you, Paul, about conversations on the ground with advisors, and conversations on the ground with advisors day in, day out are like that. Clients are pulling money out of pensions for all sorts of different things, offshore bonds. We're talking about gifting out of normal expenditure, BR. Potentially, I think,
EIS.
Well, we talked about it the last time, didn't we?
Yes,
and
EIS
might be.
It becomes into the equation.
Yeah, it has to come into the conversation. Obviously, it's a different risk profile. It's all these kind of things that advisors will say, but actually, when you do the maths on EIS, it sort of works out, and so I think that will probably. I can't see how it wouldn't be a thing in the future.
Yeah.
So yeah, I mean, in terms of our market specifically, this kind of IHT legislative upheaval is proving to be really good.
Yeah, it's a big
What's
number.
the split between unquoted and quoted? then?
Yeah,
Like,
so that's
an
Yeah.
obvious question.
Yeah, it's an obvious question. So look, the inflows, the organic inflows into AIM are very low in compared to where they have been in
And is
previous
that
years.
across the market you're seeing?
Across
that,
the market, yeah. I mean, we've had positive inflows, but only just.
Right.
But I think that it's, that's not a surprise. There's a lot of movement over this period of time where people are trying to figure out what their advice guidance is going to be. We've got this change coming in April where we know that you're going to get your £1 million allowance and unquoted, that every penny you put into from the first pound into AIM will then lose half the relief that it historically has had.
Yes.
And what we thought might have happened was a massive exodus from AIM, and that hasn't happened. That hasn't happened. We've seen just a stalling of inflows into AIM, which is to be expected, and we have seen some outflows across the market in AIM. I think what's held that up is that, firstly, it's not appropriate for everyone. There'll be people who invest in AIM because they like investing in AIM. And I think this assumption that they're going to automatically just move out because the allowance is different.
Well, and there is liquidity.
There's
as well.
liquidity.
I mean,
yeah.
I think that's something.
Yeah, that's one of the things they like. I mean, in the BR unquoted market, we would argue there's liquidity too, because
Yes.
they're big services. They've got lots of sources of liquidity. But I get it. It's not a daily priced liquid asset you can trade in the way you can on AIM. So it feels a bit different. But if you're in your 60s and invested in AIM for IHT, why do you care if the tax relief is half? If you've got a long time horizon, you might move across money when you're in your 70s, mid 70s to an unquoted and deal with the difference in the tax regime then.
Yeah.
But in the meantime, you might think, well, there's opportunity for me to make growth, and I've got some IHT. If I get hit by a bus, I've got some IHT relief. But in the meantime, I fancy my chances of making a bit more money. So it's not
almost
for everyone.
contrarian, isn't it? Because there's value there.
Yeah, 100%. Yeah. So I think that's one of the reasons why we haven't seen just an exodus. The other reason I think is because subsequent the consultation paper and the subsequent consultation issuance in July didn't really clear up the issue around replacement relief. So we still don't know the answer on that.
No.
So I think people are waiting. I'm 99.9% certain nothing will be cleared up around replacement relief at the budget because it's not really what's on the agenda. It's irrelevant to the budget, really. But I think people are waiting, hoping that maybe will be, and when it doesn't, then they'll make their decisions to make a move. And that's the conversations I'm having with wealth managers now, which is we're updating our advice guidance. We're going to sit on our hands for a moment, see what happens to the budget, and then after that, we'll get going in movement. That's not to say that they haven't been saying we're going to get out of AIM. They're saying we're going to revisit the reasons why we're in AIM and have the conversation. And inevitably, that will see a move across. So the unquoted market is bigger and growing inevitably, but that's not just AIM. That's a lot about pensions at the moment, and I suspect it will be after the budget a bit about AIM as well. But yeah, that's where we stand at the moment, I think. But we always thought the AIM market this year would be a market in flux. It wouldn't be a fundraising year. We have to wait until we get to April and then see where the dust settles. And then I think it's right for the right kind of investor.
Yes.
And this is just about getting all your ducks in a row, sorting out all the pension problems, sorting about your unquoted allowances, those things, and then we'll start again in April, I think.
Paul, you seen anything from the pension side with the EIS and I guess VCT as well? Obviously, VCT doesn't give you protection on the IHT, but you get the tax relief going in. Are you seeing monies moving out of pensions?
Certainly having conversations around that. A lot of conversation. Almost every conversation around EIS has IHT pension element to it, and not driven by Mercia. It's more that people are thinking about what they're going to do and whether it comes to BR or offshore bonds. I think a lot of things like offshore bonds have doubled in the last 12 months. So it's one of the safe havens from decades. But so I think where it goes, this capital coming out of pensions is the question. And I think BR makes some sense. EIS makes some sense. And in a weird way, VCT makes some sense because yes, you get the initial income tax relief and you get the tax-free dividend. You don't get IHT relief, but actually that 30% up front and the 5% tax-free is actually very nice and doesn't replace, but it can create an income in retirement, which is kind of what pensions are for. I think also it's quite interesting to think about pensions coming back into the estate and taxable estate, because they're not designed as a legacy tool. They're designed as a retirement tool.
Yeah.
And as much as I don't think anyone likes it, it does seem appropriate, and you can kind of see why Labour have done this. And I have a hope that Rachel Reeves is actually doing this to encourage capital which was previously in pensions being invested into S&P and foreign companies, bring it back into the UK, and perhaps through EIS invest into small high growth UK startups, and that would be very noble. I think it's probably a side effect rather than the intention, but we'll see. And perhaps she's going to come out and say that's exactly what she's trying to do. I doubt
after the event.
Yes, claim the glory for a side effect.
Yeah, because that's interesting. So what are we expecting? I mean, we've obviously got any thoughts?
He's got some notes, isn't it?
I do. Paul has read my notes. I was expecting you to steal some of my thoughts.
No, I'll just let you take the glory.
Yeah,
it's not even your thoughts, are they?
No, they're not mine. But they're definitely not yours. So thoughts on the budget. I mean, broadly speaking, as I said before, I think in our little world, in our little corner of the world, I think that the work has been done. There's very little noise.
You're referring to the inheritance
business,
tax aspect.
the IHT, the business relief world. I think that bit's been done, and I don't think there's any kind of interest in revisiting. There's been a lot of lobbying around it, certainly around AIM. There's been a lot of lobbying around it. The pension consultation paper published back in July kind of put an end to the idea that we get some sort of look through for pensions, which is something we were hoping for, but that put an end to that. So move on. So I think very little cleared up, not much expectation of huge changes. But there is a feeling now that the mood music has changed a bit around smaller companies and around AIM, just because this build up to the budget has been much more consultative than it was last year. Not just one or two meetings, but multiple and follow-on meetings and conversations where there feels like the revenue is trying to get a real take on where the market is and what would be the best moves. There's speculation which feels like it's gathering momentum about reductions in cash ISAs. The QCA at the QCA dinner, they were talking about British tax reliefs for British investors, and so I think that there's also a lot of weight behind and speculation around the British ISA becoming a thing. So look, that's something I think we should look out for. It wouldn't be a big surprise. And then the final thing I suppose is around the British Business Bank and their commitment to investing in small cap businesses and in the AIM, and that they're making all the right noises. So actually, where we were last year, we all felt like we were really in the dark. Yes. And the perhaps the government didn't quite understand. This year it feels very different. So there's lots of reasons for more optimism now, and I hope that comes through in the budget. I know, talking to our managers and speaking to people within the QCA, that's the feeling. So let's hold on to that positivity, I guess.
I expand upon that as well in terms of what we're seeing within EIS VCT world is that obviously the sunset clause extension for 10 years. So in some ways you see more and more tax coming in and IHT changes, but on the other side, there's extensions to the venture capital schemes for a decade. So I think that's a really positive sign. And I'm got a long hope that maybe even some loosening of some of the requirements, the regulation around venture capital schemes and the age or the age limits, for example, that would be quite positive. Yeah. There's lobbying's been happening, but we'll see if anything happens in the budget. I wouldn't expect it personally, but hope. And what you're saying about the British Business Bank, so earlier in the week I was at Mansion House dinner with British Business Bank, but also £1.4 trillion worth of capital around the table from pension funds and family offices, and they're actually quite pro the UK. So when we think about Edinburgh reforms and Mansion House Pact, I think it's quite hard to see how it's going to happen, but there is the medium-term expectation that more capital is going to come into UK SMEs, whether it's debt or equity. I think there is support broadly for what we're trying to do, but it's how it just feels like it's a long way away, and it just needs to get a little bit closer. Yeah, can't see at the moment pension funds allocating to venture capital, but it's going to happen at some point. They have agreed to it, and just how we get there. And at that point, then you kind of see EIS, VCT are, yes, part of the story, but then having long-term patient capital coming in to support the growth of these companies, that's going to be transformational. That's what happened in the US 50 years ago, which is how they're so fantastic at the start. As part of it, the ERISA Acts I think it was 1973 or something. But they've been doing this for a while, and if we can start to utilise long-term capital to support these companies, which take a long time to mature, then I think that's a really vibrant environment.
I was going to say, I mean, I might be going a little bit off piste here, but I was
that
thinking...
is your way, Mel.
I know, I do tend to. This might go horribly wrong. But I was thinking as well, we've got the LTAFs and them going into SIPs and ISAs. And that is a gentle way to sort of start moving this sort of long-term capital through the more private market. If that starts moving, it will sort of trickle through.
We've also seen a massive uptake in the setup of family investment companies as well. A huge uptake in that. And where that capital goes is, somebody else's business, I guess. But that would also be something that I think we'll see money flowing into different markets. I'm sure it will be because they've got to be looking for assets in there, and they're doing it from an inheritance tax perspective as well. So, yeah, that's from a planning perspective, that's something we've seen loads more of.
Yes, yeah. I didn't go that off piece.
It wasn't that bad, man. I was expecting something very different.
Yeah, you telegraphed something much more random.
I think Poppy. Yeah.
Try again. Have another go.
More random. Let's get a giggly, guys.
I feel like I'm being ganged up on.
You are.
I am, yes. So, sort of looking with the budget, then moving to the rest of the year and the, sort of April with the tax-efficient investments, do we all feel that there is a little bit of sitting on hands, and it might really sort of start moving across the board? Yeah,
I think right now there's a little bit of that. Nothing like what we saw last year, by the way. Before the budget last year, everybody was sitting on their hands. All conversations stopped. Nobody was picking up the phone anymore. Where it's not really quite the same now. What I think is interesting is that I think that this moment and after the budget is a great opportunity for managers like ourselves to innovate in product, in what they're offering. And you've started to see that in the BR market. There are insured options out there, multiple insured options out there. Will there be changes to those insurances as the legislation comes into play that means that the inheritance tax liability is different on different assets? There are a handful of people out in the market, either out in the market or saying they're going to come out into the market with the unquoted services that offer higher returns.
Yes, we've seen that come into the market already and to accommodate for that aim piece.
Yeah, there's a couple out, and I know there's a few more in the background. Yeah. So, those kind of things. And that kind of product innovation is useful now because, you've got pension money coming out, as we've discussed. You've got AIM money that might be coming out. And those kind of clients, with the best will in the world, the 3 to 4.5%, 5% target returns for the elderly client in an unquoted BR strategy. If you've got younger clients looking at it because of their pension situation, that might not be that attractive for them. So something a little bit higher. So that kind of product innovation, and hopefully there'll be more of that. I think it's an opportunity for businesses like ours, and I don't know about EIS and VC, but
it's kind of where private markets and BR collide, isn't it? And like they are actually quite similar asset bases.
Yes.
A lot of them, as we were discussing earlier on, and obviously private credit's kind of 8 to 12% returns, and BR is obviously quite a bit lower than that. But there may be some innovation around those edges. But I would beg to differ respectfully on. I do think on EIS specifically, there is a lot of sitting on the hands. There's very not much is going on at the moment. Even with a decent amount of capital being returned. So some of the other managers returned 40, 60 million in the last 12, 18 months, and they're still really low flows.
Do you think that might be, though, as a result of perhaps capital not being returned so well in the few years before that, and that sometimes it takes a little bit of time to switch people back onto it? Certainly in the advisor market, if they feel like it's not gone how they wanted it to go, then to persuade them, actually, look, this is how the market's progressing. It takes a minute to do that. And that actually, fingers crossed, we might start, with the money returning, you might start to be able to get those conversations, and it might start to turn the tide in your favour a bit.
Well, from my experience, what tends to happen if money it's returned to clients, half or a quarter just automatically gets reinvested into those same products because they've proven themselves. But that hasn't happened, which is a bit of a surprise. So I think there is a bit of sitting on the hands. But at some point, there is also the element of the capital gains. Various people sold businesses before the last budget, and quite a few business sales are ongoing still. So that CGT clock will be ticking. And at some point, I do expect, in combination with the pension reforms, CGT and pension reforms could be a great driver for EIS in addition to income tax relief. And VCTs, I think it's just dependent upon what products out there, which I think the large managers out in VCT need to expand how much they're deploying, because I think there is demand there for it. But that will take them a bit later stage potentially, and kind of Series B. But I think that's appropriate. But I don't think there's any big innovations. The knowledge intensive EIS is quite interesting for a lot of people. It gives some security in terms of what tax year the income tax relief is coming in. So I think that is something which we are seeing more and more adoption of.
Yeah, and administratively as well for an advisor, so much nicer. Yeah.
So, but I think that it's the sentiments ecosystem which needs to be a bit more buoyant than for EIS especially.
Well, there's a lot of speculation, isn't there, around what for the broad outside of our markets, what the broader strategy that the Chancellor is going to take in towards raising more taxes, cutting costs, and it seems more and more likely that will come from breaking one of the manifesto promises. It's kind of got to. And that will be that looks like it might be income tax, and if it is income tax, that's that kind of point
leads
back
into the production, doesn't it?
Yeah, it does.
Well, there are all sorts of random things that are being talked, and there's a lot of kite flying going on, and like EV charges and primary residence capital gains tax. But I think income tax is the one that's most likely, and I think it's also fair because everyone's got income tax is such a big tax already. It means that everyone's taking burden rather than just the ultra rich, because they will emigrate otherwise.
Yes. Of course they will, and they're already starting to in mass numbers. But the thing about that is that you can protect the poorest members of society and raise income tax at the same time. You just have to raise the basic allowance, and so you can protect the portion of the least well off. And if you take it from whatever it is, 12,770 or something, whatever it is, and take it up to 20,000, and then put a couple of pennies on income tax from there, then we'll all be a little bit annoyed. But rather than what we've seen in the previous budget, which is lots of pockets and sectors being really, really annoyed. I think if everybody was just a couple of pence annoyed, I think we'd all take it on the chin and move on. And that's probably sensible.
Doesn't sound very Labour though.
No.
To be political, sorry. I hope
does sound sensible though, doesn't it?
It does sound sensible.
So moving on.
It's got sensible.
But Mel doesn't like it when I'm saying
but I'm conscious of time as well. We've got to get to the awards tonight. What are we thinking up for awards?
We're up for Best VCT.
Best VCT?
Yeah, we're up for Best Quoted and Unquoted BR. And
double whammy for you
utterly
then?
Furious if we don't win both of them.
Right.
Oh dear.
Okay.
There's only downside for you tonight.
Yes, the only downside. You're up for Best Platform.
We're up for Best Platform.
Okay.
Yeah.
And just to be clear, they are not our awards. A lot of people think they are. We actually got an email through this week asking if they could put a drinks order in for their table.
What did you say? Yes, you may.
Send me the money.
We gave our table number.
We gave our table number.
Yes. It's the only correct response, really.
Exactly.
Isn't it?
Exactly. Perfect. Well, let's see what happens after the budget. We'll all be back. And yes,
indeed.
Cheers.
And thanks for your valuable insight,
I can't
guys.
actually reach, but
Thank you.
Cheers. Perfect. Thank you. To hear more, tune in to either YouTube on video or all good podcast channels.